Okay. Okay, so now we're going to use, okay, the information, okay, that we have already learned in the previous part, and to see, okay, on the sensitivity analysis, okay. So this is when there is changes, okay, in fixed and variable costs, okay. So what will be the situation if fixed costs change or variable costs change or sales price change? What will be the effect to the profit, to the, and also to the volume, okay. So changes in costs, okay, will affect the volume and profit. Okay, so this is called the sensitivity analysis, the what if situation. Okay, so a systematic way of asking what if scenario question in order to understand. Okay, so in the sensitivity analysis, okay, there are actually three approach that is commonly employed. Okay, so the what if analysis, the margin of safety, and the operating leverage. Okay, so here I'm going to explain only on the what if analysis, okay, MOS and operating leverage. Okay, what I can say is not in the finals, okay. So I will give you the, okay, I will also show you, okay, the calculation nanti, okay. What if analysis, margin of safety, and operating leverage. Okay, so these are the three methods of sensitivity analysis. Okay, so we're going to look into the what if analysis. Okay, so here we want to see if there is any change in, okay, if there is any change in either one of the costs, whether it's fixed cost or variable cost, or even on the sales price, okay, what will be the impact on cost, and also on what will be the impact on volume, and also on the profit. Okay. Okay, so what happens? So sensitivity analysis usually is applied when we ask what if scenarios. Okay, so for example here, what happens to profit if, okay, selling price changes, volume changes, cost structure changes. Okay, so cost structure changes is whether the variable cost change from the original amount, or the fixed cost change from the original amount. Okay, so whether the variable cost increase or decrease, or fixed cost increase or decrease. This is the change in cost structure. Okay, and what if can also be used if the volume change. Okay, so if the company, okay, or the organization targets a certain amount, okay, a new amount to be achieved. Okay, so you can also use this what if scenarios application. Okay, and if for instance you change the selling price, okay, so you can also use this what if situation calculation. Okay, so let's look at an example, okay, of the what if application. Okay, for an example, if a company determines that an ad campaign, okay, so costing 15,000, so the company is actually they want to employ a new campaign that costs 15,000. Okay, and if they employ this campaign, okay, they projected that, okay, the sales will increase by 25%. Okay, so they want to know whether they should proceed or not. Okay, so this question cannot be properly answered without doing this type. Okay, so here the information is not complete. Okay, so they say that they want to know whether this campaign 50, the amount of this campaign is 15,000. Okay, if they employ this, uh, it would increase sales by 25%. But now they must know if they implement this campaign, is there any changes to the cost structure? Okay, does variable cost change or fixed cost change? Okay, so if variable cost change or fixed cost change and the selling price change, okay, then they will have to look at the viability of adopting this campaign and the viability if not proceeding with the campaign. Okay, so this is the what if analysis. Okay. So usually you can see how business strategy will affect profit by changing the selling price, by changing the variable cost, and by changing the fixed cost. Okay. Okay, so consider the following example. Okay, so Rydell ini example. So what if analysis. Okay, Rydell is considering buying a new machine. Okay, that would increase monthly fixed cost from 24,000 to 30,000. So it states here, if Rydell buys a new machine, the fixed cost will increase to 30,000. Okay, now the fixed cost is 24,000. But then if Rydell choose to buy the machine, it will increase to 30,000. Okay, and in the same time, okay, unit variable cost will reduce, okay, from 70 to 60. Okay, so fixed cost will increase to 30,000, variable cost will decrease to 60. The selling price will remain unchanged. Okay, so two costs are changing, variable cost and fixed cost. So what is the new BEP in dollars? Okay, so because there is a change in the fixed cost and variable cost, you have to determine the new BEP. Okay, so this is the revised contribution margin. So now you will use the new information to get to the new contribution margin, and the new contribution margin ratio. Okay, now selling price is still the same, so it's unchanged 100, but variable cost is now 60. So use 60, you will get the new contribution margin to be 40. Now, what will be the new contribution margin ratio? Okay, so because this is the new contribution margin, so you will apply this, okay, to the calculation, and because the selling price does not change 100, so you can still use the information. And now, the new contribution margin ratio is 40%. Okay, so now you have those the two information. First, you have to calculate, okay, the new variable cost and the new fixed cost, and then input it in the same formula. Okay, and then based on the new amount, okay, you can calculate for the break-even point in dollars and break-even point in units. Okay. Okay, so Rydell is considering buying a new machine. Okay, so now you want to know what will be the BEP in dollars. Okay, so you have already calculated the contribution margin ratio. So now the revised fixed cost, the new revised fixed cost is 30,000. Okay, so use this new amount, 30,000, divide with the new contribution margin. Okay, so the revised break-even point will be 75,000. Okay, ataupun the new break-even point will be $75,000. Okay, so if you want to find in units, it's the same also. Okay, you will take the revised fixed cost and divide by the new contribution margin. Okay, so the new contribution margin is also 40. Okay, so you will get the same amount as the contribution margin ratio. Okay, so if the contribution margin ratio is $75,000, okay, then for the break even in units, it will be 75,000 unit because the unit selling price is 100. Okay, so it's easy. Okay, kalau lain dia lain Okay, another example. Okay, Story Park competes with Splash World by providing a variety of rides. Okay, so Story sells tickets at $50 per person as one day entrance fee. Variable costs are $10 per person and fixed costs are 240,000 per month. Okay, so this is before. Okay, now suppose. Okay, so situation, what if situation? Suppose Storycard cuts its ticket price from 50 to 40. Okay, now selling price reduced to increase the number of tickets sold. Compute the new break-even point in tickets and in sales dollars. Okay, so it doesn't say anything about the changes in variable cost and fixed cost. So the only change here is the sales price. Okay, so you have to find the new sales price. Okay, so the new sales price will be 50 minus will be $40. Okay, so the new sales price will be $40. Okay, so what will be the new contribution margin? 40 minus 10. Okay, to find the unit sold, okay, fixed cost over contribution margin per unit. Okay, so this is fixed cost over contribution margin per unit. So 240,000 divided by 30, so 8,000 units to break even. Okay, so if you want to find in terms of sales dollars, okay, you have to find the new contribution margin ratio. Okay, so the new contribution margin ratio will be 10 over 40. Okay, no 30 over 40. Okay, and then 240,000 divided by 30 over 40. Okay, so get that CMR ratio to get this amount, 320,000 sales dollar to break even. Okay, okay, so the old break even is 6,000 units and the amount is $300,000. Okay, so you can see here, even though that they decrease the ticket price. Okay, okay, no, and you can see here that if they increase they decrease, okay, the ticket price, okay, to break even will require another 2,000 units. Okay, so it means here that previously their break even is low. Okay, so after 6,000 units, they can actually gain profit. Okay, but now the break even units have increased. Okay, so it means here to get, okay, to get profit, they will have to sell more than 8,000. Okay, so is the decision good in cutting the ticket price? Okay, so you have to decide, okay, based on that. Okay, so that is the analysis. Okay, okay, now another situation. Okay, here Story Park increases the variable cost. Okay, so compute the new break-even point. Okay, so that was situation 1 or alternative 1. Now alternative 2. Okay, what if, okay, they increase the variable cost, okay, and the fixed cost remains and the selling price remain at 50. Okay, so only change the variable cost. So what will be the new break even? Okay, so you will have to change, okay, the variable cost. Okay, so now sales price is the same, 50, so minus 20, you will get 30. Okay, so this is the new contribution margin per unit. Okay, so the fixed cost does not change, so 240,000 divided by 30. So you will get 8,000 units to break even. Okay, but in terms of sales dollars, okay, the amount is different. Okay, here if you reduce the sales price, okay, the sales dollars to break even will be 320,000. Okay, but here if you increase the variable cost, the sales dollars to break even is $400. So it means here you have to get, okay, even though 8,000 units is to break even, but the sales is not good, okay, as compared to reducing, okay, the sales as reducing the sales price. Okay, because here 8,000 unit, the amount in sales dollars is only 320,000. So it means that if they can get more than 320,000 sales dollars, okay, they will gain profit. But here, the amount of sales dollars must be $400,000 to get more than $400,000 to get profit. So which one is better? Okay, reducing the price or increasing the variable cost. Okay, so two situations. So you have to choose. Okay, and give the justification. Okay. So those two situation are examples of what if analysis can be used. Okay. The situation changing in fixed cost, changing the sales price, and also changing the variable cost. Okay, so example lagi. Okay, so now okay, the unit sales price is 200, unit variable cost 80, fixed cost is 12,000. Okay, so this has changed. Okay, and then okay, given the fixed cost 12,000, the contribution per event is 120. Okay, so you get the break even sales in unit to be 100 and the break even sales in dollars to be 20,000. Okay, so now tengok apa jadi. Okay, so with the original, okay, 200 sale price, the break even point was 100 event. Now, if you lower the sales price of 180%, the break even will increase to 120,000. Okay, so ni situation yang kedua. Okay, so the lower the sales price. Okay, so what will be the effect? Okay, so the effect is that if they lower the sales price, okay, they have to increase the break even point. They will have to achieve 120,000, 120 events before break even. Okay, so that is if they lower the sales price. Okay, so the lower sales price means that each event contributes less toward fixed cost. So the company must sell 20 more events to break even. So this is not a good choice. Okay, if you decrease the sales price, because you will have to sell more, okay, to achieve break even. Okay, now if you change the fixed cost, okay, so what will be the effect? Okay, so the effect here is that if you change the fixed cost, if you increase the fixed cost, okay, the to achieve break even will require more, also will require more events, 25 events more from the original. Okay, if you reduce the fixed cost, okay, then you have to calculate to see, okay, what will be the effect, okay, from the original. Okay, so what you can conclude is that higher cost will yield higher unit sales to break even, and lower cost will yield lower unit sales to break even. It means that if you increase any cost, okay, so it means that you will have to also increase, okay, the amount of sales. Okay, and if you lower, then you will decrease the amount of unit to be sold. Okay. So you have to read sebenarnya this situation. Okay, so these are some examples of the situation that will occur. Okay, if you change, okay, the cost structure. Okay, so this is a summary. Okay, now if you increase selling price, okay, the effect of the result will decrease the break-even point. Okay, so increase selling price, you will have to sell. You don't have to sell a lot of amount. Okay, from the original break-even point, but if you decrease the sales price per unit, okay, the contribution margin per unit will decrease, and you will have to sell more than the original break-even point. Okay, for the variable cost decrease, okay, you will have the variable cost increase, it will decrease the contribution margin per unit and will increase the break-even point. And for variable cost decrease, it will increase the contribution margin per unit and decrease the break-even point. Okay, and total fixed cost, okay, will not affect the contribution margin per unit, but it will affect the break-even point. Okay, whether it increase or it decrease depends on whether the total fixed cost increase or the total fixed cost decrease. Okay, so that is for part 3. Okay, and then there is for part 4, its application of the margin of safety and the degree of operating leverage.